Coming to another profitability ratio, that is return on investment. In short, it is also referred to as ROI, that is return on investments. Sometimes it is also referred to as ROC, that is return on capital employed. Now students, it is a very important ratio. It can be calculated by using this formula, that is net profit before interest, tax and preference dividend upon capital employed into 100. Remember that the numerator has net profit which is before interest, tax and preference dividend upon capital employed in the business into 100. Now students, what does this ratio tell us? This ratio gives us a clear indication of the profit margins or the returns that a business is able to generate for every rupee invested. It gives an indication of returns generated by the business for every money, for every rupee. That is, let's say you have invested a sum of 10 lakh rupees and this ratio comes to 30%. That means you are earning rupees 3 lakh out of your business activity by investing that 10 lakh rupees. Now students, somebody might think that how come this ratio is different from gross profit ratio and net profit ratio? Remember, they are calculated on sales, but this ratio gives us an indication of the returns that we are generating on the capital invested by us in the business. It is not on sales. It is the return that an owner is able to get when he invests a certain amount of capital in the business. So it is return on capital employed, whereas gross profit is return on sales. Let us understand how we can calculate these components. First of all, we look at capital employed. Now students, by capital employed we mean the money that we have invested in the business, and obviously capital is invested for long-term purposes or for long-term period of time. So generally capital employed includes those items or those heads through which money is invested in the business for long-term purposes. So capital employed can be calculated by formula shareholders funds plus long-term loans. Remember, long-term loans are also money invested in the business for long-term purposes. So they form a part of capital employed in the business. Now students, this formula can be further divided into different categories. Like for example, shareholders funds. Shareholders funds can include share capital. That includes both equity and preference, plus reserves, plus, and remember, reserves include free reserves. Sometimes securities premium is also given. So students, remember, securities premium belong to shareholders. So it is a capital reserve which is a part of share capital or shareholders funds. So reserves, free reserves means reserves like general reserve, profit and loss account and so on, which are included in this, but it also includes securities premium also. So we'll just take it as reserves here. Share capital plus reserves minus fictitious assets. Fictitious assets means those expenses which have not yet been written off. We all know we have done them in the balance sheet. Now students, this is for shareholders fund plus long-term loans. Remember, long-term loans, as we had done earlier, can include debentures, loan from institutions or loan from banks which are of long duration. Calculation of capital employed is from the asset side. So the other formula says that capital employed is equal to net fixed assets plus net working capital. Now students, we can also subdivide them. Net fixed assets are equal to gross fixed assets minus depreciation, and net working capital is equal to current assets minus current liabilities. It can also be further refined as fixed assets plus current assets can be taken as total assets. So the formula can be total assets minus current liabilities as well. So students, now we have two formulas for capital employed, one from the liability side and this one from the asset side. Now remember, these are vaguely called like this, although current liabilities are taken from liability side, but most of the items have been taken from asset side. Now let us come to the numerator part. The numerator was net profit before interest, tax and preference dividend. That is very clear. Net profit before interest, tax and preference dividend. So students, how can we calculate this one? Usually it is clearly mentioned, but in case we are given net profit after everything, so we will add preference dividend, we will add tax and then we will add interest back to the profit so that we get net profit before all these items. Once we have these two figures, we can divide them to calculate return on investment.